Interest rates appear simple. They are often described as the cost of borrowing money. But in modern financial systems, interest rates influence far more than individual loans. They shape housing markets, corporate investment, government debt, and asset prices across the entire economy. When rates fall, borrowing becomes cheaper. Credit expands. Asset prices often rise. When rates increase, the opposite occurs. Central banks adjust interest rates to stabilize inflation and economic growth. Yet these decisions ripple through a complex financial system built on leverage and expectations. Small changes can alter the cost of trillions of dollars in debt. Entire markets respond. This is the story of interest rates and why a single number can influence the direction of the global economy. Interest rates represent the price paid for borrowing money over time. In modern economies, central banks influence this price by setting benchmark rates and guiding short-term funding conditions. Commercial banks, corporations, and households adjust their borrowing decisions based on these signals. Mortgage rates, corporate loans, and government bond yields often move in response to central bank policy. Financial markets also play a role. Investors buy and sell government bonds, influencing longer-term interest rates through expectations about growth, inflation, and policy. Because debt levels are high across modern economies, changes in interest rates affect balance sheets broadly. Governments refinance large amounts of debt each year. Corporations rely on borrowing to fund expansion. Households often carry mortgages or consumer loans. Interest rates therefore operate as a central control mechanism within the financial system. Interest rate policy promises a stability. By adjusting borrowing costs, central banks attempt to balance economic growth with inflation control. Lower rates stimulate spending and investment. Businesses borrow to expand operations. Households finance home purchases. Governments support economic activity through fiscal policy. Higher rates slow expansion when inflation rises too quickly. Borrowing becomes more expensive. Demand cools. The system appears manageable because policy changes occur gradually. Central banks communicate intentions through forward guidance and economic projections. Markets interpret these signals and adjust expectations accordingly. The promise is smooth economic management. Interest rates function as a dial that policymakers can turn to stabilize cycles. However, the effectiveness of this mechanism depends on how financial markets respond to policy changes. Interest rates have played a central role in economic policy for decades. After periods of high inflation in the late 20th century, central banks gained independence to manage monetary policy more actively. Over time, interest rate adjustments became the primary tool for influencing economic conditions. Markets learned to watch central bank decisions closely. The rise of financial globalization amplified the impact of rate changes. Capital flows quickly across borders in search of yield. A shift in policy in one major economy can influence borrowing costs worldwide. During the years following the global financial crisis, many central banks reduced rates to historically low levels. Some even adopted negative rates. Low borrowing costs encourage governments, corporations, and households to increase debt. This environment supported economic recovery and rising asset prices. It also increased sensitivity to future rate changes. When debt levels grow, even modest rate increases can have large effects. Interest rate systems fail not through sudden collapse, but through accumulated pressure. When rates remain low for extended periods, borrowing increases. Investors search for higher yields. Asset prices may rise rapidly. Leverage builds across the system. When inflation rises, central banks may respond by increasing rates. Borrowing costs climb. Debt that once appeared manageable becomes more expensive to service. Corporations refinancing debt face higher interest payments. Households with variable rate loans experience rising monthly obligations. Governments see increased costs on newly issued bonds. Financial markets adjust expectations quickly. Equity valuations, which often rely on discounted future earnings, may decline when rates rise. The challenge lies in timing. Central banks attempt to slow inflation without triggering severe economic contraction. Because modern economies rely heavily on credit, rate increases can tighten financial conditions rapidly. Lending standards become stricter. Investment slows. If tightening occurs too quickly, economic activity may decline sharply. If tightening occurs too slowly, inflation may persist. The system operates within narrow margins. Interest rates must balance growth and stability while influencing trillions of dollars in debt. A severe interest rate shock could trigger widespread financial stress. Asset prices might fall as borrowing costs increase. Highly leveraged institutions could face refinancing challenges. Banks would reassess lending risks. Investors might move capital into safer assets. Central banks could respond by slowing rate increases or providing liquidity to stabilize markets. The collapse, if it occurs, would likely emerge as recession rather than financial panic. Credit growth would slow, economic activity would contract. Interest rate adjustments rarely destroy the financial system outright. They reshape it. After periods of tightening, central banks often shift toward easing once inflation subsides and growth weakens. Interest rates decline. Credit conditions gradually improve. Economic activity stabilizes. This cycle has repeated across decades. While tools and institutions evolve, the central role of interest rates remains unchanged. They remain the primary mechanism through which policymakers influence financial conditions. Interest rates appear to be a simple price, but they govern complex interactions across financial systems. They influence borrowing decisions, asset valuations, and capital flows simultaneously. Modern economies depend on credit. Credit depends on the price of borrowing. When that price changes, the effects ripple through households, corporations, and governments alike. Understanding interest rates is not simply about monetary policy. It is about understanding the mechanism that connects money creation, credit expansion, and financial stability. In modern finance, interest is more than a cost. It is control.